to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have a weekly strategy roundtable where we talk about current market conditions and answer any questions you might have. This is my brief bio, but background in technology. I was a CTO of several publicly trading companies. Good to go. Thank you, Paris. Once the company went public, decided to manage my own money, building technology. This is what my background is, using the latest advances in AI and neural networks. And in the past over a year now, we have Keith from Option Hotline, who's also part of the live trading room, specializes in options, has deep understanding in the options market. He used to be a hedge fund manager and trader on the floor, so a lot of experience. So that's our background, modeling and actually managing, using the signals to manage our portfolio. Disclosures are very important. I'm going to go through specific trade ideas, so please take a look at disclosures. Options clearing, to understand the risk and suitability associated with trading stock and options. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. All right. Before we jump into some of the rules, let's talk about current market conditions. Usually, if you follow me, I use SPX. So we can see that the market continues to grind higher. It's trying to break out. You see SPX making new all-time highs. SPY is making new highs. We have QQQ technology making new highs. So you have a clear breakout of all-time highs. Market continues to go higher. A lot of it to do with interest rates. So we have a sharp pullback in interest rates in the past couple of weeks, de-escalation in Middle East. Hard economic data still supports, low probability of recession, and market continues to grind higher. We talked about, if you remember, before June expiration, right? In the past couple of weeks, I said that, a lot of it has to do with the gamma and positioning, right? It doesn't really matter what, I think or what you think individually, right? What matters is what collectively is all traders or majority of the traders think, right? And if you look at the gamma, which shows you positioning, right? This is total gamma positioning across all expiration months, right? And we're talking about billions of dollars. Like if you look at the gamma, even if you don't trade options or you don't understand Greeks, the idea is that somebody is placing billions of dollars worth of investments into these contracts, and these levels become support or resistance, right? So right now the gamma is $30 billion. I think it was $150 billion for June expiration. So the $150 billion expired, and now people got to repositioning, and then there basically allows the market to go higher. We were pinned at 6,000, and what used to be support becomes now resistance is becoming a support, right? The highest level of positioning is still at 6,000 level. So now the put wall, SPX put wall, is the 6,000 level, right? This level is where the buyers will step in, and the flip point is actually 595, right? So the flip point between positive and negative gamma basically saying that as long as we're above 59.50, the buyers will step in, right? The dealers will step in to be neutral, gamma neutral, and delta neutral. And you can kind of see that in the price action of the SPX. And SPX is actually 61.75. In terms of next level, I mean, 6,200, we're 1% away from 6,200. And now biggest gamma is actually getting positioned at 6,300. Right, so 6,200 is the next positioning, then 6,300, and then it kind of slows down. So market is grinding higher, interest rates are lower, VIX is lower, right? Volatility, we're at multi-month low on volatility. High yield continues to grind higher at year-to-date high. That's a proxy for risk taken. Bitcoin is underperforming. That will be the only sign. Like in the past, Bitcoin was leading the market. Right now, it's lagging. Right, it's lagging QQQ. It's even lagging SPY because it's not making new highs. But semiconductors took the leadership again. They were underperforming since July of last year for the past year, And finally, the Nvidias of the world are taking leadership role, and they're continuing to grind higher, and make new highs. So all of that is bodes well into the idea that the market continues to go higher. We actually have small caps trying to do a catch up, still underperforming, but we made new highs since February, right? Since the sell-off started, new highs. So small caps are participating, regional banks are participating. You have a broadening of the rally, right? If you look at the stocks above 50-day moving average, we're back to 2025 high, 2024 high. Still a little bit more room to the upside, but a very sharp rebound nonetheless. How about percent of stock? Percent of stock above 20-day moving average. Still, pull back. Still more room to the upside. Okay. And the opposite price action in gold and silver, gold miners, gold, silver, they're all down because they were a good hedge for the uncertainty in the market, and now people are pulling back. So if you look at our models, if you look at the stock forecast toolbox for the next 10 days, it actually see that the spiders neutral trend, but continue grinding higher, potentially reaching 620. We've seen a lot of overhead resistance at 620. Doesn't see a lot of momentum below 600. So that confirms the positioning based on futures and options data. That as long as we're above that flip point, 595 on SPY, market is going to continue to go higher. You buy and pullbacks. Short term, obviously, the market is overextended by any stretch of imagination. Right? It's been a straight line for many weeks since the lows, April lows. But it's a straight line V-shaped recovery, making new highs, and we're grinding higher. So just because market is overbought, that doesn't mean you're going to have any meaningful pullbacks. Probably shallow, couple percent pullbacks based on the news flow. Next news is unemployment data on Thursday. So Friday is off, happy 4th of July, and then unemployment data on Thursday. So until Thursday, we have ISM manufacturing. That's important, but I don't think it's going to surprise. Manufacturing data has been slowing down, so I don't think it's going to be a big surprise. But employment data, it has to be, this is the bear argument that if the market pull back, one of the reasons it will pull back because the economy is slowing down and it's causing the unemployment to rise, right? And that's a dual mandate for the Fed. So as long as the hard economic data doesn't support that, unemployment rate is going up, then business as usual. So that's something to keep in mind. So if you look at let's look at July expiration, right? So what do we think is going to happen by July, going into the next earnings cycle, right? And August, what do we think is going to happen to the market, right? If I look at the standard deviations, right? So one standard deviation were 6,300, right? We went through this exercise last week, right? I think we didn't break out, so we said 6,200. Now it's 6,300. So one is that we're actually going to make new highs, right? We're going into the next earnings season in July. AI is still at the forefront. Everybody's spending money on AI projects, infrastructure, data center, software, developers, and utility. And you have one standard deviation move to the upside, right? We're actually we're going to break these overhead resistance, right? The momentum is going to be the bullish market sentiment, right? Distribution of possible outcomes, right? We always talk about trading is, it's not market going up, going down. It's basically your opinion on where the distribution of possible outcomes can happen, right? One is two standard deviation to the right. Second, one standard deviation is scenario number two, which is trading sideways. Basically, somewhere between 595, right, and 6,300, right? Especially that this guy is well supported. And then scenario three, where we're gonna take out this put wall, right? We're gonna take out the 6,000 put wall, and we're going to 5,900, 5,800. So that's the distribution of possible outcomes, and I encourage you as a trader to always go through this exercise. I mean, a lot of people, our subscribers, trade monthly options or weekly contracts, right? Or trade stocks, they're holding it for a couple of weeks. So you think about July, August, right? I mean, you can do the same exercise if you think in quarters. You can do the same exercise if you think in minutes or hours, right? So whatever type of trader you are, right? And that depends on psychology, right? Your trader profile. Some people are risk averse. Some people like to take more risk. So that's fine. But the process is the same. You analyze certain time frame. You look at the probability of certain outcomes, and then you decide how much money you're willing to invest based on your opinion. And that goes through that positive negative rehearsal exercise, because if you're bullish and you think we're going to 6,400, you need to decide how much money am I willing to risk. So that could be your reference point, right? You can say, okay, I'm wrong if we drop below 5,900, right? And then you want to make sure at that level, if it does occur at 5,900 or 5,800, you're not down. Your entire portfolio is not down more than 10%, right? If you're a new trader. If you're an experienced trader, maybe 15%, maybe 20%, that's fine. But majority of the people, especially when you start new, I encourage you to risk less, right? It's kind of the opposite. When you start trading, you risk more, but then once you realize that this is a combination of art and science, and it's, just the distribution of outcomes as you get that experience, then you realize that, okay, I need to think about positive and negative rehearsal, and then you become more, in line with the risk, right? Because you start trading, this is expectation, right? Psychology. And then there's a gap, right? There is a gap between expectation and reality, right? So the idea is to narrow this gap, right? We wanted to narrow this gap. That, unfortunately, I think only happens with time. Very few people can actually listen to someone like Vlad and just say, okay, this makes sense, I'm gonna do it. You have to go through that experience. That's why I encourage you, if you go through the experience, start with only 4 positions, small number of positions, and go through this exercise to make sure that at this point, if you set 1, at this point your position is not down more than 2.5% of your portfolio. So on a $10,000 account, $250. On $5,000 account, $125. And then sometimes you'll be right, sometimes you'll be wrong. You keep your journal, you document this, and then rinse and repeat. All right, so let's go through this rehearsal exercise. Next big event outside of, there's a few unknowns, right? We have geopolitical risks still. There are obviously de-escalation, but that's still on the table. We have big, beautiful bill is due, right? In the next couple of weeks. We don't know, the deficit is going to go by $2.5 trillion in the next 10 years, by $4 trillion. Nobody knows, right? But so far, it's uncertainty, and that's going to also impact the market. Then the debt ceiling has to be raised to finance this, right? Is there going to be any liquidity issues in the bond market? We've seen already signs where Treasury auctions for 20-year yield, 30-year, they didn't go well. Now they're fine, so it seems like there's more liquidity, but once in a while we see these periodic issues. Tariff deadlines, right? Canada, Mexico, the 90-day extension is coming due, then Europe is coming due, and then China, right? And in 2018, it seems like we've found an agreement with European Union and Canada and Mexico and Japan, but China was much harder to find an agreement with China, and that caused the market to actually revisit the lows. So all of these things are still there. It's not priced into the market. This is low, but I would not dismiss it, right? I would not assume that it cannot happen. That's why these exercises are very important. So on that note, how many of you say, Vlad, earnings season is coming. It's, Microsoft, Nvidia, Palantir is going to, hit a home run. Market is going to continue grind higher. So we're going 2 standard deviation to the right. We're going to be above 6,300. How many of you say, Vlad, there is still risk in the market? Unemployment might tick up, inflation might tick up due to tariffs, So there's still uncertainty. It's, economy is not growing, right? GDP was revised down 2, right? We could get to 6,200. 6250, but we can also get to 6,000, maybe even 590, right? So scenario 2, we're trading in a range, right? As we approach in 6200 or 6250, maybe you trim your position, right? And when you approach here, maybe you add, right? This is maybe a buy zone, and this is maybe a sell zone. And how many of you say 3? Unemployment is gonna rise rapidly beyond what Fed expects. Fed will be forced to either lower interest rates aggressively or respond to either elevated inflation or elevated recessionary pressures. Status quo will be changed, and we're going low. We're on our way to revisit the lows. All right, how many of you say 1? Denis, Ed, Arminder is back. Welcome back. John, Pam, Paris, Robert, Simon, and Tim. Is this Tim? No, not Tim. Somebody new. Trader, CGOGINENI. Welcome, guys. Thank you for participating. We have a nice turnout. Sorry I was late last week. I apologize. Some of you were on the broadcast. How many of you were on the broadcast last Friday? And I was late. Just say yes. So if you are, I apologize. All right, how many of you say 1? Robert, Simon, Pam, Denis, Ed. Anyone? 1, 2, 3. Nobody? You guys, can you guys hear me? Maybe nobody's listening. 1. All right, Pam. Thank you. All right. So some of you said 1. Nobody else? Okay. I'm gonna say 2. We are breaking out. I think my core scenario is the repeat of 2018, right? That the market if you look at the spiders and you just travel back into the time, first administration, first term of Trump administration back in 2018, same thing. The tariff escalate started, second half of President Trump administration, and China pulled back in January, right? Then tariff negotiations, it reached the low accidentally in April. And then since April, sharp recovery, new all-time highs by 3 to 5% higher, right? I think it was from here to the top somewhere in August, 2%. So we reached the high in actually it lasted all the way to the beginning of September, actually October. I mean, it peaked at August. So it peaked at the end of August, but it would continue to rally through July, through the August, and actually made new highs in middle of August. It's a little bit earlier. It's doing it in, last week of June, first week of July. So grinding higher till, end of August, plateau. And then when the 90-day tariff came due with China, China says, well, not so fast. And the market pulled back, right? So I still think this is kind of a core scenario that's going to happen. All right, Robert, thank you. Chuck, welcome back. So that's I think that's the core scenario. Obviously, if China plays along nicely and agrees to everything that U.S. is concerned, then we're not going to have a revisit of the lows. I mean, if they do, then the probability of revisiting the lows will substantially increase. So that's my take on the market. I'm watching interest rate. I think that's the most important chart. As long as it's stable, as long as we're not below 350 or we're not higher than 5, I think market grinds higher. Dollar is concerning. We're making new lows. So for now, the only side effect of weaker dollar is that Europe and Japan and Mexico, they're outperforming US markets, right? So in your 401k, you might want to consider diversify outside of the United States, right? Or if you like, their market is not as liquid. But if you want, I mean, they do have options on stocks. So I mean, so in 401k, I just bought, you know, you can buy Europe, you can buy Germany, you can buy emerging markets. They're all have very similar price pattern. They're all breaking out, right? Whether it's emerging market or Germany, right? Price patterns are the same. And gold, you know, pull back. You know, probably buying to pull back. If you think we're going to revisit the lows, then you want to buy and pull back. Any questions? How do we help on Tradespoon? So we have different models. We've already looked at stock forecast toolbox model. Basically shows you what the next 10-day trend is. You can look at 1 hour, you can look at 6 months. I mean, 6 months basically says that we're a little bit ahead of ourselves. This model ran on the 1st of June. Obviously, didn't anticipate such a strong rally. Market is overextended. 590 doesn't see much overhead resistance, much rally beyond 590. Obviously, we're already at 610, so we're, you know, outpacing. But that shows we are overextended. I mean, model will recalculate on July, so this vector is going to get more bullish. But still, you can see that market is overextended by any stretch of imagination. Any technical indicators you can use, we can see that it is too fast, too far. Doesn't mean it cannot keep doing that for next couple months, but you know that the market is overbought. Any negative news, and you will have pullback. I don't think it's going to happen till August, but you know, it could come earlier based on the either hard economic data or some geopolitical risk and stuff like that. So stock forecast toolbox, you can also use active trader. This is where I get a lot of my signals and trade ideas. So every day, right, you can go in and just say, hey, what were the signal today? What were signaled yesterday? Right, these signals could last for a few days, a week. Right, Nvidia, Caterpillar, yesterday Netflix. You can see these are all strong stocks. Model finds them. Today, Disney, Schwab, financials, you know, Nvidia again. So you can build a diversified portfolio using these signals. If you want to day trade them using day trading, because the signals are meant for a couple of days. Right, the signals are meant for a couple of days. Right, it's analyzed in a shorter period of time, makes projection for the next few days, right? And that momentum can stay for a week, 2, right? But beyond that, you're kind of on your own, right? For the active trader. Weekly trader, you know, this is few weeks, a month. The monthly trader, you know, a month, few months, because you analyze in different amounts of data, and model learns and trains on that data and makes inferences for that time interval that it's been trained on. And the idea is, if you're using these signals, let's say for day trading, Disney, you know, you entered either at the previous close price or predicted low based on pre-market futures. Pre-market futures were up, so I would use 121.46. Usually I wait, if you're doing day trading, I usually wait 15 minutes, or even if not day trading, you want it to give, you know, at least when the market opens, 15 minutes. And if you see where it's still at previous close high, right, wasn't a gap actually. I mean, it pulled back, then you enter the price. Right? So models suggest that 121.46. Right, you entered 121.46, and you know, you look in this example, I would look for 1% gain, and you exit when it's at this level, right? 1% up, your exit. You know, if you're gonna hold it for a couple of days, maybe 1, maybe 2%, right? So that's how I would use these signals, right? But I think waiting 15 minutes makes sense. A lot of people don't; they just do it at the open, but they're consistent. The idea of you want to be a disciplined trader, kind of rinse and repeat. Right, you don't want to change the amount of time you hold in this position. You know, if it goes in your direction and you usually wait a week or 2, then great, you close it. If it goes against you, you still close it, right? So rinse and repeat, disciplined trader, mechanical trader, that's the goal, right? I always have this association in Orange Theory, right? I use the Orange Theory, and they have the sketch me if you can exercise, right? So you have to run, and you have to pass certain distance by certain time. And if you don't, then you get off the treadmill and you start rowing or lifting weights. So trading is the same thing, right? Catch me if you can, right? You put on a trade, and usually there's a certain amount of time and certain amount of distance that the stock should move based on the time and distance, right? Because stock behaves the same way. It's physics. A lot of it is just physics and mathematics, right? So a certain amount of time, it can go through a certain distance, and then you wait that time, and then if it moved in the right direction, right, then great, you're out. But if it didn't work out, okay, then you get out, right? And you move on to the next signal, because these signals are trained on the models that analyze a certain amount of data for a certain period of time, right? Trading is a vector, right? Three-dimensional vector, right? You have to be right on magnitude, direction, and timing, right? So all those three, you have to kind of be right, especially with options trading. Stock trading, you might be off on time, but again, if you're not following the time, then you're kind of on your own, right? Because if the model has been trained to make predictions for a couple of days, but you're holding it for a couple of weeks, well, you're holding it because of your own reasons, right? Because your own analysis, or you think Schwab is going to continue going higher. Okay, great. Then you can hold that position. Could you explain more on gold, please? Sure. So gold has been used as a hedge against uncertainty. So you could see it goes through consolidation. It's not making new highs. It reached the peak during the tariffs, right? Uncertainty about tariffs, and now trading sideways. So I think gold is a hedging mechanism right now. Very low level of uncertainty. I would be a buyer into pullback onto gold. I think gold can be a good hedge against your portfolio. So if you're bullish on the market, I would take 5%, I don't know, 10% of your portfolio and just keep using it to buy gold on pullbacks, because that's the hedging mechanism. And that's the only asset has been well correlated to downside pressures in the market. Paris, thank you for kind words. Armin, I've been rallying for the roadblocks, since strong uptrend continues to go higher. So, obviously individual stocks, there could be extension. Obviously it's straight line overdone. It just needs one negative news. It could be earnings and it will pull back, right? So, this is a momentum stock, overextended, usually have elevator up. You could have elevator down on the negative news. I don't know, next earnings season. 40 days. As we approach in earnings, I would be more careful. It does look overextended to me. Thank you, John. So on Yellow Tunnel, on Tradespoon, we offer Elite Circle, right? You can go into Elite Circle and actually look at our trades. So it's a combination of both stock and options trade. So, I closed Cisco trade. Same thing, it was a signal on Monday. Right, Monday was a signal. I did the example of both option and spread. So the stock I started at $67, right? And I exit half at 68, half at 68.75. Very nice rally, along with the market, 3% move. I'm out, right? Option, I bought at 262, it's trading 320, I'm still holding that position. So this is an example where you would see both stock and option examples. General Electric was just option, right? And that was, and I held, I was holding it for longer, 30 days, right? So it's a weekly trader. The signal was generated. I bought it at 4. It stock pulled back, bought it at 340, and then I'm out at 410, 480, looking for 20 to 30% gain using option spreads, right? So those are the type of trade, stock and options. Also, I did Micron. Micron. These are what stocks. These are trades, earnings trades. Micron had earnings where I tried to make over triple-digit gains, right? 100%, 200%, 300%. So it was well-defined risk. So here I risked 60 cents, and I did the put spread and the call spread, right? So bullish call spread, bearish put spread, with the idea that Micron is going to move similar to other times in the past 4 quarters or other chips companies that it's either going to hit a home run or it's going to strike out, but it didn't move, right? It didn't move. So I was long volatility, and it didn't go anywhere. So this is a losing trade. So here I'm risking 60 cents, but I could have made $4.40, right? So every week I try to do one example of earnings trades. Sometimes it's calendar spreads, sometimes it's butterflies, verticals, but this is a well-defined risk where you could have outsized return. So those are examples of some of the services we have. You can see all the trades in the lead circle, right? You can, look at the SMS messages. You can participate morning bell and closing bell. I encourage you to participate live. I know a lot of people are busy, don't have time, so at least watch the recordings. Right? A lot of people say, Vlad, I entered this trade, I never exited. What happened? Why? My only was the response, well, were you in a live trading room? And if not, did you watch a recording? Well, if you didn't do any of that, then I mean, signals are great, but somebody has to manage those signals, right? We give you tools, but somebody has to use these tools. So if you need help to use these tools, then please join live trading room, or at least watch the recording, or at least come to a Strategy Roundtable. Because if you're a new trader and you think this is just get signal and buy, it's more involved, right? You have to look at the macroeconomic analysis, market conditions, positioning, a lot of things you have to look before you take the signals and trade them, right? So I encourage you to participate in live trading room. Try out Elite Circle, you get access to all of the trades for 30 days. There's other services we have. We talked about Active Trader, Weekly Trader, Monthly Trader, some of the tools, but you can just watch the spread services, right? Spread trades, you can watch stock trades. But I would start with Elite Circle because you get access to everything. It's a 30-day free trial. Try it out. If it doesn't work, you get free education, right? Risk-free, right? You don't take any risk, but worst case scenario, you get 30-day of knowledge for free, right? You get your refund back. So try it out. All right, guys, I gotta go. Thank you very much. Have a great weekend. Remember, next week, shorter week. Remember, today is also weekly expiration. So if you have any options expired today, if you want to close them, if you have July contracts, think about thinking about monthly contracts. There will be only 3 weeks left. So something to keep in mind. Any questions? All right, Denis, Ed, Paris, Robert, Simon, thank you very much. Have a great week, and thank you for participating. I'll see you guys next week, same time. Please try to make it. Thank you.